And welcome, this is Mary Ellen McGonagle with your weekly Edge show for October 27th. Today, as usual, we're going to take a look at where the broader markets closed for the week. We had a fairly negative period, and you'll want to know where those areas of upside resistance and potential support are. Also, some of the headline news that drove price action last week. Certainly earnings were in there as well as a big driver. And last up is viewer question of the week, and it's all about should individuals be buying these defensive areas that are holding in better than the broader markets. So let's go ahead and take a look at some of that data from last week. First up, we did get new home sales numbers, and they did surge to their highest level since February of 22. Now, this was very surprising given the rise in mortgage rates up to very close to that 8% level, but it's also indicating a strong economy. Next up, we did get third quarter GDP numbers, and it jumped to 4.9%, mostly fueled by continued spending among consumers. Also, we did get core PCE data. This is a key metric of inflation for the Federal Reserve that came out today. It rose 0.3%, indicating that inflation remains sticky and elevated. Originally, we did see the markets rally today, but we faltered into the close. Also, we did see consumer spending numbers, and they increased by 4% in the third quarter. And again, indicating that the consumers are still out there spending, which has everything to do with increased wage pressures and a low unemployment rate. All about, again, numbers that are going to keep inflation elevated and hence potentially interest rates. Next week, another very important week with October employment data due out. This is going to be closely watched by the Fed as well. And also Fed Chair Powell will have a press conference, and those comments, of course, will be closely watched. As into the close, we did see the S&P 500 is now in a correction as it is down 10% from its recent peak. We'll get into that as we move forward. So let's just do that. Take a look at where did we close for the week. And here we are with a daily price chart of the S&P 500. And a couple of metrics we want to be aware of. First up is the fact that we did decisively close below this key 200-day simple moving average, where we will take a look at a longer-term chart and examine the significance potentially of that. Also, our RSI remains trending downward below that net neutral 50 in negative territory. It is approaching an oversold position, and historically when that occurs, you at the very least will oftentimes see a bounce. We also have stochastics of faster moving momentum down below 50 and also in oversold territory below that 20 level. And the other item of note is the fact that this longer-term 50-day simple moving average has trended now more recently over the last 6 weeks into a downtrend. And historically, that does create a rather heavy pattern from which to eventually re-emerge. However, if we go back to, and see if I can, back here, we did have that market bottom here on October 16th. At that time, we did have a downward trending 50-day moving average. Eventually, you have a leveling off, and as it trends higher, it does provide more confidence when we do experience a downtrend reversal that it can remain uptrending. Now, from here, let's take a look at the NASDAQ. We do want to also be, of course, aware of where that stands. This is a daily price chart, and you can see that we did break below this 1300 level, high volume indicating distribution, and this RSI is in negative territory, as are the stochastics. So when we are on the lookout for a potential area, next area of possible support, we will be looking at lows from earlier this year. First up is going to be this mid-May level, and it stands at about 12,400. From here, let's go ahead and take a look at a weekly chart of the S&P 500. We want to get a good feel for the longer term view for this broader market indice. And what we are looking at here are the characteristics being highlighted coming out of a bear market, in this case out in 2020 on the weekly. When we can get that RSI into positive territory trending upward, that's going to improve the intermediate term outlook for the broader markets, get those stochastics up above 50, trending higher. And if we move forward, we can see at the beginning of this year, when the markets began to stabilize, at the very least, we had that RSI on the weekly chart really moving around this mid-neutral area. And here, more recently, it's of note that on the weekly, we do have a downward trending RSI and the stochastics still heading south. In other words, intermediate term, we do have work to do by way of stabilizing and eventually moving higher so that we can have confidence that the markets can regain their uptrend. Let's take a look at some of these S&P 500 sectors. This is a 2-month daily price chart view. And up here, what I did want to do is add an RSI indicator and sort these sectors in descending order so that the strength is exhibited up here. For the most part, we do have utilities, staples, and REIT, some of those more defensive areas up here at the forefront. We'll get a little more into that with that viewer question for the week. But let's take a note here that technology is up here at the forefront. It's not a particularly healthy looking chart, but the tech industry group did fare better than the broader markets. We'll also take a look at some of those heavyweight names in the tech area, and you'll see where that relative outperformance is stemming from. But at the end of the day, tech is in a downtrend at this point in time. Some of these other sectors we can take a look at that have really faltered. Healthcare fell 4% for the week. You can see this deterioration here, all about earnings, mega pharma companies coming out with not great numbers. And then also we can take a look at some of these other areas that are faltering, and that would be financials. These bank stocks are coming in with numbers that are not healthy. They are not guiding higher. And this is not what you want to see as it relates to healthy strength in the markets in a very confirmed uptrend here with financials. Moving along, we also want to take a look at some of these other industry groups that the markets are comprised of. And again, 2-month daily price chart view. And let's take a look. Gold here up at the forefront, sharp uptrend, safe haven. Commodity here trending higher. And these high volume bars here indicate accumulation characteristics similar to the beginning of March. This is right before the markets reversed, and you can see this uptick here during the banking crisis, the move to gold. We could see further upside, but use this period as precedent, as this late May period showed the uptrend had ended. Taking a look at some of these other sub-industry groupings, volatility, this is that fear index remaining elevated above that 20 level. We need only go back again to this banking crisis period when volatility spiked. However, we did see a reversal in the broader markets, but it was all about interest rates being in a downtrending phase back here that helped elevate the markets. And at this point in time, this high VIX number is not a good backdrop for any thoughts of a reversal into an uptrend just yet. Interest rates still remaining elevated, the yield on that 10-year at 4.8%. And we can see if we go back and take a look, I talked about this period here in March when the markets were able to, beginning of a nice rally, was this yield on that 10-year dropping below 4% and getting down as low as 3.3 and remaining at low levels while the markets traded higher. And obviously we are at a much higher level here at this time. We do need to see interest rates get down to at least that 4% level would be ideal. Also, as we move through some of these other sub-industry groupings, you'll see that semiconductors, SOXX is the ETF, remain in a confirmed downtrend. And also from here, we can take a look at software stocks, also trending lower, very, very sensitive to a rising interest rate environment. It's causing these growth names to really come under selling pressure. From here, let's go ahead and take a look at some of these defensive areas. First up, I do want to share with you XLRE. That is a REIT ETF, and actually it's the real estate sector. And what I wanted to share with you is we did have a couple of rally days last week due to strong earnings from a couple of underlying areas. However, we have this lower low, which is not constructive, and not a lot of vibrancy to the upside. If we compare that to consumer staples, which is another defensive area, we certainly were in the beginning stages of potentially reversing that downtrend. We can see that RSI close to getting into positive territory, and at least that MACD black line up through the red. However, today's pullback has negated the possibility super near term of a downtrend reversal in consumer staples. Let's take a look at utility stocks, also being driven as most areas by earnings. And this is actually a much more constructive chart. You can see that we have higher lows taking place. This index is moving above these shorter term moving averages. We were very close to posting a positive RSI before pulling back today. And from here, we can see this black line up through the red. Now, while it is firming up, this is not a positive looking chart. We do still have upside resistance potential here at this 50-day moving average, but certainly of the three, it is the most constructive. One of the big drivers this week was a move into next year and EE gap up into an uptrend, but you can see also that that has faltered. So as it relates to these safe haven areas at this point in time, they are not attractive. So from here, let's go ahead and take a look at some of those mega cap tech and the Magnificent Seven. Take a look at where they stand at this point, because they were the leadership names, certainly for the most part of this year. We want this leadership to come back into play to help propel the markets higher. And then, of course, we do want to see broadening out beyond that, ideally. So this is a 2-month daily price chart view with that relative strength indicator. So in other words, up here at the forefront are your stronger names among these 8 stocks. I did include Netflix in here, and it is up at the forefront. We had that gap up the week before last on earnings, and it was seemingly retaining that, although over the last 2 days, pulling back. We are still above that 50-day moving average. We do still have positive RSI and MACD. So certainly of those names, it is in the best standing. Microsoft came out with good numbers this week, and it had a gap up in response, very heavy volume. However, unfortunately, we did fill that gap, which is not good news with the pullback. However, Microsoft was a relative outperformer today, and we do still have a positive RSI and a positive MACD, which certainly bodes well if the markets were to move into an uptrend. These 2 names would be positioned to outperform. Amazon did gap up in response to their earnings today. However, it fizzled into the close, certainly in line with the markets, but we never got into positive territory with this RSI and MACD, so the weakness remains near-term outlook for Amazon. Taking a look at some of these other names, we can see Google's outsized decline in response to weak numbers and then a continuation pullback. At this time, we are in an oversold period. We could see sideways price action. And we can also take note that back here in February, the company at this time also released poor earnings, and the stock did deteriorate. It from peak to trough. It fell as much as 15% before stabilizing. So on the lookout for an eventual movement here in similar fashion. You will want to see the stock post a higher low, and then we will also want to get that momentum shift by way of the MACD, black line up through the red into positive territory, get that RSI trending upward, and from there, Alphabet was able to recover from that earnings-driven drop back here. That's it for this week, guys. Have a great weekend. I'm going to look for you again here next Friday. Hey, Mary Ellen here with Simpler Trading. Thanks for watching the video. If you liked what you saw, go ahead and hit that like button and leave comments below. And if you'd like to be notified to future videos, you can hit that bell icon and subscribe. Don't leave without subscribing to my MEM Edge bi-weekly report. I do have a special trial offer. And for those who'd like to learn about trading live with us, you can go ahead to simplertrading.com to learn more.